Hey, what's going on guys? Welcome back to another video. In today's video, I want to show you a few different things that I'm looking at in the market and specifically a few options that I'm planning on buying. I want to analyze some active options, especially because, when I take a look at the market, we've had some stocks that have had significant pullbacks like, AMD, Shopify just reported earnings and they're down 17%. Roblox is down 23%. Airbnb is having some action. So I want to show you maybe 4 or 5 different option plays in this video that I am really looking at in terms of a short-term opportunity. So first of all, I just want to review my portfolio. Although the market is very choppy, I've had a lot of wins actually. I'm still being very consistent. So if you do want to follow along with trades that I'm making like this, having a lot of success here, then you can check out my description. The first link is a private community where I give students lots of signals on buying and selling different options. Now, specifically what I want to look at first is Shopify. Shopify is down 17%. They had earnings and the reason why they're down is most likely because they had bad earnings. Now, this is a really good opportunity to use options. I'm going to show you 2 different option positions. First one I'm going to show you is a put credit spread, and I'm also going to show you a call debit spread. I'm going to explain it very simply as well. So let's go to good old Shopify. Shopify down about 17%. Now this stock was trading at over $1,000 not too long ago. Literally in the beginning of the year, it was over $1,000. And then you can see right here that it's been trending right around $850. We've had some decent support here at $800. However, we've broken down below support because earnings weren't so good. And if I scroll down here on Robinhood, you can see here that they missed earnings. Earnings were estimated to be $1.58, but Shopify came in at $1.36. Now I'm just looking at this as a technical trade because this stock is down. I see a lot of opportunity in selling a put credit spread. So let's open up Trade Shopify options and I'm going to take a look at a few specific strike prices and I'm going to tell you why I'm picking these strike prices as well. So first of all, a put credit spread is just betting that a stock will not fall further. And because Shopify is already down so low, it's certainly down way below its moving average. It's definitely below its Bollinger Band. And this stock is actually at a 52-week low. So I can expect this stock to maybe recover once they get in some good traction, some good momentum again in the next quarter. They may recover back up to $1,000 per share. But for now, looking at this stock, it looks majorly sold off. Step number 1, sell put option. You can go short term, but I don't want to go too short term because I still want you to have an opportunity to make some money here, even if you're watching this a few days later. So I'm going to go to March 18th. This is a 1-month option. Obviously, this is still not financial advice. I'm just showing you exactly how I'm thinking about trading a stock that has sold off and is at a 52-week low. So March 18th is what I'm going to be looking at for expiration. That is 30 days out. Now, because Shopify is already at a 52-week low, you can technically just sell, 730, 725 area for the strike price. However, as you'll notice here, the premium is massive. It's really, really huge. So I'm actually going to be a lot safer, even though this stock is at a 52-week low. This doesn't mean that you want to be risky. You still have to keep in mind that when you open up a position, you want to have proper risk management. You don't want to just go into a position that has a high chance of losing. So I want to make sure that my chance of profit is still above 70%. So 75% is pretty good. That means, 3/4 of the time I'm going to be winning here. Now, taking a look, this is the 650 strike price. If I expand this option, you will see that the bid-ask spread is a little bit wide, which isn't ideal. However, the implied volatility is very good, even after earnings, which is, pretty rare because if you will notice after earnings, there's something called an IV crush. There's a lot of implied volatility expected before a stock reports earnings. However, after it reports earnings, usually the implied volatility will dramatically go down, which is called an IV crush. And that's because the catalyst or the event that option traders and the market was expecting has already happened. So there's not much more that can happen. However, with Shopify, you'll see that the implied volatility is still really big. So this is something that, is going to be a good or attractive option to trade because, you guys already know, I prefer selling options. I go for weekly income or monthly income. I'm going for income strategies. And the higher the implied volatility, the more money you will collect off of selling options. The delta right here, 24, this is good. So I'm going to open up a sell put option right here at the 650 strike price. Now, to open up a proper put credit spread, because this will cost a lot of money right here, I'm going to protect myself and buy a put option. I'm going to go 1 leg lower at 645 and click this button right here. Now you will notice that the total credit is $1.40. So I'm going to click $140. Now my risk taken here is 500. However, and the reason why it's 500, by the way, is because 650 minus 645 is 500. However, because I'm collecting 140, my true max loss is only 360. So my actual return here is really high. It's over 30%. So this is a very attractive put credit spread to open because you're collecting $140, which as a percentage is right around 30%. It might even be 33%, which is a fantastic return in 1 month. Obviously, if you just do this for 3 months in a row, you can have a 100% return. All right, now the next thing I want to show you is going to be a call debit spread. So basically this video is going to be a complete masterclass on spreads. You're going to learn so much. So really make sure that you're paying attention right now. You have your notes out because Uncle Henry wants to hit you with as much knowledge as possible. And if you appreciate that, you can always smash that like button for me. It really helps out the channel. So to start a bull call spread or a call debit spread, they're both the same things. For this strategy, you are going to be bullish. So say that Shopify has pulled back significantly, and I just showed you the first strategy is selling put credit spreads. But now let's say that you're bullish immediately. Like you're bullish right now. You believe that Shopify is going to rise, for sure up to like $800, maybe 8 to 10. So what you will want to do in this scenario is you're going to want to buy a call option. Now, you don't want to just buy a call option because it's going to be extremely expensive. So if I go down and purchase the 750, this is going to cost a total of $4,785. Super expensive, and not many people should or want to spend that amount of money on just one call option, especially if you have a smaller portfolio, because $5,000 is basically going to be a very huge chunk of a small portfolio. So instead, because so many people have small portfolios and they're looking to aggressively grow them, instead a bull call spread is going to be way better for a small portfolio looking to 2x or 3x their money. So check this out. You want to do sell call option. Now you can go up 1 leg up, or in fact, I can go up 2 leg ups because it's going to be very simple, very easy math, because this is a $1,000 bull call spread. Now, if I go sell this, now you will notice that the total cost is $250 and the total reward is $750. Now, in fact, you can turn $250 into $1,000 because the total gain here is $1,000. However, you're only putting up $250. So $250 can turn into $1,000 in 1 month. So you can 4x your money if Shopify goes up to $760, and there's a 72% chance of this occurring. It's not even that far out of the money. Currently, the stock is trading for about $729. Now, if the stock just moves up $30, it's going to be at $760, and you're going to be able to 4x your money. All right, so this is called a bull call spread. Now, if you'll notice here, you're going to lose on this trade if Shopify stays below your break-even price of $752.85. Now, the reason why it's $752.85 and not $750 is because you're spending $285 roughly to open up this position. That's why your break even is $750, the first strike right here, plus the premium that you pay. So this is a fantastic strategy for any small portfolio looking to have aggressive growth. Obviously a 4x return. Now it's currently less than a 4x return. Now it's pretty much a 5x return. It does vary. That is because of the bid-ask spread. So I'm gonna get this video out as soon as possible for you guys, to take action if you want to. Or of course, just take these strategies and use it on something else. So for example, let's go back to Yahoo Finance. I'm gonna go back to ticker symbols that have had a lot of movement because that's where I see a lot of opportunity. As soon as a stock has a tremendous move up or a tremendous move down, that's where you wanna start paying attention to potentially running, one of these strategies where you're using a spread to either collect 33% by, selling a put credit spread, or by buying a bull call spread and having a potential to 2, 3, or 4x your money. Now, it depends on the person's risk tolerance. Everyone's different. I have some of my students that want to really 3 and 4x their money, and it really works out. And then some students that want less risk and they go the put credit spread route. I recommend using both of these strategies in your portfolio because the more strategies that you use, the more diversified your portfolio is going to be and the lower volatility you're going to have in your performance. Now, the next stock that I want to look at, there's a whole lot of them. Space is currently under $10. Nvidia is pulling back to $259, and Nvidia has earnings later today. Tesla's pulling back. But what I really want to look at is probably going to be Palantir, and then I also want to look at Facebook. I'm going to open up Facebook first. I'm going to go into Palantir right after Facebook. So Facebook, or Meta Platforms, which they changed their name to, this stock has become really cheap. And in fact, this stock has made really no sense because over the past year, it's sold off so heavily that it's again at a 52-week low, just like Shopify. So basically a similar strategy will be very good on Facebook. I'm going to show you a put credit spread. Now I'm also going to pick which strikes to do this put credit spread on. That is pretty much the most important thing because you want to pick the correct strikes. Far too many students make mistakes by selling a put credit spread and going way too close to the money. That is a big error because, for example, say you go for 215, 212. Sure, this is going to trick some investors because the premium is going to be really high. So check this out. If I sell the 215, 212 and a half, I mean, the total credit right here is $98. And you're collecting 98, you're only risking 150. This is a really huge return. It's like a 40% return in just 2 days. But obviously the reason why it's 40% in 2 days is because it's too risky. It has way too much risk. And if you want consistency, you don't want to do that. You really don't want to be that risky. I'm going to go 1 week out. I'm going to make this a little bit different than Shopify. I'm going to show you what a 1 week option is going to look like, or a 1 week put credit spread. So we're going to go sell put. Now I'm going to go down. I'm going to go down to where my chance of profit is going to be much higher. So right here, if you'll notice, the chance of profit is 83 and Facebook is going to have a strike price of 200 here. The break even is actually 198. So this is significantly cheap. I mean, Facebook was a $350 stock. Under 300, I liked it. Under 200, I mean, get out of here. Just way too cheap. So this is going to be a very good bet. Sell put option at the 200 strike price. Now I'm going to click buy. For the smaller portfolios, by the way, you can buy the 197.5. That means you're going to put up about $250 worth of risk on the table. However, if you have a little bit bigger portfolio, say $5,000, then there's no worries with opening up a 195 strike because it's still not going to be that much money in comparison to your portfolio. I mean, you're going to be risking $440 right here, which, it's still less than 10% of a $5,000 portfolio. Now, the total credit here is about $59. So, 10% of, $500 is 50. So this is actually over a 10% return in 1 week. So, if you can collect 10% return in 1 week, that's 40% a month, which is going to be astronomically high on a yearly basis. Now, obviously you can't win 100% of trades. Some of these trades will go against you, but the whole name of the game is to put the odds in your favor, is to make sure that you have the highest chance of success possible. So this put credit spread right here, I'm looking at 200 put and then 195 put for a total put credit spread of $60, roughly $60 in total credit. So this is something that I would be looking to open for next week. Well, currently, but this would expire for next week. Now, I do also want to show you a call debit spread on Facebook. This is going to be another strategy that I'm looking at because, technically Facebook can have a huge recovery short term, especially because the market continues to sell off, but we will see a recovery at some point. Even in the most bearish market out there, you're still going to see many short-term bounces. So going out to February 25th, which is just 1 week away, just slightly over 1 week, I'm going to look to buy an at the money call option, a 215. Now again, this is not that expensive, but still it's $610. But instead of paying $610 to open up a call debit spread or a bull call spread, they're both the same thing. We're gonna go ahead and sell the 220 call option right here. Now the total cost is only $230 and the opportunity for gain is about $500. 220 minus 215, $500. So this is over a 2x return. So you can 2x your money in 1 week on Facebook bull call spreads. Now, the last thing that I do want to look at is going to be Palantir. Palantir has gone to some really cheap levels. For Palantir, because the stock is so cheap, I wouldn't necessarily do a bull call spread. I might not also want to do put credit spreads. Instead, what I might want to do is I might just want to go and sell some put options. Now, the reason to sell some put options is because Palantir is really cheap. If you look at the 13 strike, they do have earnings. So the 13 strike, it has crazy premium. I mean, $68, this is insane. Now, I wouldn't do put credit spread because they are a little bit more risky, especially when a stock has earnings. And because Palantir has some earnings coming up, I would go down and maybe sell the $12 put option, collect $37, which is going to be 3% in 2 days, or even you can go out to February 25th. You can sell the $12 put option, and this is going to have $48, which is a 4% return. So there's a lot of passive income to be made with selling put options. And if you do want to master selling put options, you want to get a lot better at it, I have a perfect video that you can check out on the screen right here in my playlist.